Welcome to the CFO Show. I'm your host, Melissa Howatson, CFO of Venice Solutions.
And I'm Tom Sigmiller, VP of FP&A at Venice Solutions. Melissa, it's no secret that we're in a tough economic environment right now. Companies seem to be cutting back across the board, regardless of industry. And we've got private equity firms that are seemingly being more prudent and discerning than they otherwise would have been in normal economic environments.
You're exactly right, Tom. We've seen a tightening in the capital markets. It used to be that money was far more free-flowing and relatively cheap to access compared to today. What that's done is companies have absolutely pivoted towards a greater emphasis on profitability, in some cases just needing to extend that cash runway a little bit longer because it's not as easy to go out and raise money as they thought it would be. At the same time, some companies might be thinking about raising money and trying to navigate how to do that in this changed environment. Think about some of the scale-ups or startups and where they're going. Fortunately for us, we've got a great guest today who is very familiar with navigating complex situations like that. Lots of experience with scale-ups, startups, and growth companies. He's involved in private equity, and we're really fortunate that we actually work with him on our board at Venice Solutions. I'm thrilled to welcome Peter Arrowsmith, Managing General Partner of JMI Equity. Peter, thanks so much for joining us today.
It's my pleasure. Thanks for having me.
Peter, can you maybe kick us off by talking through some of the different types of fundraising companies might be thinking of? Public markets, venture capital, private equity?
I think the capital markets remain, wide open for companies with some clear trends that have happened over the last few years. But the capital markets I would define as, the credit markets are open. The credit markets are highly functional. That said, interest rates have gone up. The cost of capital has gone up as it relates to raising debt or raising credit that a company may want. And I think while the credit providers and debt providers are clearly open for business, what they're looking for in a business, what they're looking for in a company financially has continued to evolve in this environment. On the equity side, the private markets for equity are as robust and available as they've ever been. I mean, the clear move over the last 20 years of the capital markets from public market to including a much larger private market economy is as strong as ever. That said, raising money in the private markets today is choppy. It's hard. There's lots of capital available, but the expectations from private investors have gone up over the last couple of years from a peak in 21. And so activity for raising money has slowed down in 2023, but the markets remain very open. And I think the IPO market, the public markets, we have not seen a lot of public market new issuances, new IPOs. It's available, but I think that's a window that is, has been mostly shut during 2023.
And when you think about venture capital and private equity, any differences there in terms of what's happening, or both available but slightly higher bar for what they're looking for?
Yeah, it's a great question, Melissa. I think they're both, look, let's step back. Over the last few years, the private equity, growth equity, and venture capital that's been raised by institutional funds is at an all-time high. So there's more capital available. You'll hear the phrase capital on the sidelines, but there's more capital available than ever. There ever has been. That said, what's happened over the last couple of years is that in 2021, we had the most robust private capital market activity we've ever seen in the history of private markets. I've been doing this 30 years. And 2021 was the most robust year. That has been followed by a significant slowdown. Some will call it a hangover. There's other words, right? It's clearly slowed way down, whether you measure that by number of transactions or by capital deployed or capital invested. It has slowed significantly. Why is that? I think there's a few factors. The first is with the valuations that were achieved in 2021, they were at an all-time high. So activity levels and valuations obviously go hand in hand, and they're at an all-time high. Valuations came, I wouldn't call it crashing down in 2022, but they came down significantly in 2022. So the multiples, whether that's a cash flow multiple, a profit multiple, or a revenue multiple that investors were willing to pay in 2022 and 2023 has changed significantly. The reasons for that are a few. One was, I think we had a bit of a bubble in 21 coming out of the pandemic. The other real reason is that we had the interest rate increase in 2022 that the US Fed has put in place to combat inflation has made the cost of capital across all capital classes go way up. So the valuations coming down, there was a ton of activity in 21. So in 22, there was a natural slowdown. I think in 23, that slowdown has continued with one added, I think, complexity, which is, I think investors have mostly, and companies have mostly seen the valuation, the multiples companies are willing, or investors are willing to pay, level. So that's healthy. The valuations, the multiples have leveled out, but the performance of companies has been choppy in a very, what I would call an uneven and hard to predict demand environment from their customers. Company performance has gotten choppy in 23. Companies are missing forecasts. You see it in the public markets, you see it in the private markets, and that's made it hard for investors to value those companies, and it's made it hard for board of directors to want to get into the markets to raise capital with uncertainty in front of them.
What a fantastic grounding around the markets. Peter, can you share with us a little bit about JMI and your role at the organization? I think it would be really great for the audience to learn more about you and JMI.
So JMI Equity is what's called a growth equity investor. So we are in the broader private equity world, and we sit in between kind of classic early stage venture and late stage buyout. We are growth equity investors, specifically in the B2B software markets. So we've been investing in B2B software or business to business software companies now for 30 years. We're investing out of JMI 11, and we invest in software businesses all over North America through private transactions. My role at the firm is I'm both an investor, so I take the lead on making new investments into companies, as well as I'm the managing partner of the firm, helping run the day-to-day operations. We have 75 employees across our investing team, our professional team, and our operating team.
You mentioned that you haven't seen anything quite like this in over 30 years. Can you share with us the journey that the capital markets have been on, specifically in the last 3 years?
Yeah, it's a great question, Melissa. So, look, we had in 2020, we all went through, an incredibly unique experience around the pandemic. And let me speak about the software market. So, the software markets felt almost an immediate slowdown in demand in March of 20, right? Companies didn't know what they were going to do. People had to move home. There was just this abrupt slowdown. A few months later, I think a lot of companies realized, wow, software is going to be part of how I solve the challenge of doing business in a pandemic. And we had a significant uptick in demand for business solutions. And that lasted for a while. So there was almost a bring forward, if you will, of demand. And that there's a natural sort of cyclicality to software buying. And we clearly felt a spike in 21 and into 22. And over the last, what I would call 12 to 18 months, that has tempered, right? There's been digestion of that software. Folks have bought, companies have bought, customers have bought. And I think while it hasn't been anything slow down like we saw in 2009 or 2010 around the great financial crisis, as a relative comparison to 2021, I feel like companies have felt a pretty heavy slowdown in demand. So that is something that many managers and executives and leaders are feeling for the first time since 2010. And so it feels like a pretty new, pretty differentiated environment. So I think folks are dealing with, okay, how do I budget for 2024? How do I think about projecting what is coming in 2024? How do I communicate that to capital providers? And I think that's the process many companies are going through that feels a bit different than we've seen for a decade, frankly.
Yeah, I think it's a great summary that you give there. And I like how you described it as there was almost this pull ahead, and now there's that smoothing out that's happening when some of that demand was pulled ahead. Certainly changes, I think, for businesses. It feels like a bit of a whiplash here that's gone on over a couple of years, but you really describe what's happened there and has caused that sense of things changing and feeling a little more turbulent right now than what would have been there before. So thanks for that.
Yeah, the only thing I was going to add is, well-run companies, which most businesses out there are well-run, and well-run companies, they know how to like kick off a project that may include buying software or buying a service or involving a consultant or using third parties, but they also know how to slow them down. And that's what I feel like we're dealing with right now, is that projects where you would use software or you would use a third party to help you solve a problem or address an opportunity, many of those projects have just been slowed down. That said, I am highly confident that over the near term, that's going to come back. And I think, it is cyclical. We've seen lots of business cycles, but also we're in secular growth. And I feel like the secular growth around investing in technology, investing in software will come back. And I feel like it's just around the corner.
I'm wondering if at this point we can dig in a little bit to how this environment has ultimately changed things for PE firms. We've been talking a lot about portfolio companies, management teams. How has it changed your environment and what you do?
Yeah, great question, Tom. I touched on a little on this at the beginning, but with the valuation repricing that's happened over the last couple of years since this really spiky 2021 we all went through, that sort of the classic bid-ask spread between companies who want to raise money or transact and the investors who are ready and able to make those investments, that has clearly slowed down the market for both M&A, so that would be mergers and acquisitions or transactions to sell companies or parts of companies, and it has slowed down the transactions around investing growth capital onto balance sheets, right? So there's less activity in our markets. So, we've seen that kind of slow down before. We're in the business of meeting, high quality, high growth software companies. We haven't slowed down the meeting in the spending time and the building relationships. The number of transactions has clearly slowed. We are fully prepared and fully expecting that 24 and 25 are going to get back to more normal activity levels.
And Peter, you gave a great summary of what's happened the last couple of years, what has changed. And so then for companies that may be looking to raise money now in this environment, just how hard is it for companies, or any advice you've got there, as they think about it? It feels hard. Curious your sentiments on actually how hard it is and how long is this environment here to stay?
Great question. I think it's hard. This is going to be let me step back. This is going to be a little bit of a tough answer perhaps for some, but the environment we're in right now is there's a lot of demand from folks like JMI to put capital to work. I would say the bar is high. So for companies that are performing well, it is a great time to actually tap the capital markets, to talk to investors, to talk to folks who may want to provide them credit, because there is a lot of capital on the sidelines that I described earlier. So if you're performing well and you have a good handle on the business fundamentals, in your business and why the near term and medium term will perform in a way that you think it will, it's a great time to be in the markets because there is real demand. And the valuations have held up. High quality companies are demanding high quality valuations today. I think for businesses that it's a bit choppier, my advice is really spend the extra time to prepare and understand what's driving the results in your business. Be as intellectually straightforward and intellectually honest as you can about what's driving that performance. Again, prepare, be overly ready to talk about your business and be prepared to talk about both the pros and the opportunities and some of the headwinds you may be feeling. And I think the folks who are prepared that way and are ready to chat and have those conversations, the markets are absolutely open. I think where it's particularly hard is for companies who are not as tight, for lack of better words, about what's driving the results in their business. And I think businesses that miss their numbers while talking to investors have a particularly challenging time.
Well, sometimes you need some of that hard medicine, right? So I think it's helpful. I love how you highlight, always when something feels tough, there's always an opportunity there. And you talked about that importance of, building the relationships and getting your story together, that this does give a window of opportunity for quality assets to be building those relationships. And I think you're flagging they should actually be building those relationships. I remember back in 2020 and 2021, there were so many companies trying to raise money. Sometimes it was hard to get investors' attention for very long because there were almost just so many assets that they were trying to take a look at simultaneously that they didn't have the time as well to always be digging in. Whereas now there's that time. If there's this capital on the side, there's not maybe as many going to market because maybe they're not ready. I think it's a great piece of advice for folks to build those relationships and take this opportunity to actually be building that and getting in front of investors and helping them understand the story, even if that's just helping to create the relationship for something that might come down the road, because these things don't just happen overnight either. I don't think, you talk about preparation, and we're going to get into that a little bit. You can't just wake up and decide you're going to raise money, boom, there you are. Should always be thinking about this and optimizing, getting ready for that. So thanks for that advice.
On average, when we make a new investment, we've built a relationship with those companies for an average of 4 years.
Wow.
Right? These are long sales cycles, and companies ought to take the opportunity when they don't, quote unquote, need capital to build those relationships, whether that's with lenders or equity investors. So Melissa, that's terrific advice you give.
Can we circle back to the concept of fundamentals that you alluded to before, Peter? So if we were to get a little bit more tactical for the audience, what are those attributes that you're looking at when evaluating a company? Is it revenue growth? Is it predictability of revenue? Is it profitability? Is it gross margins? How do all of those components interact, and how do you ultimately view them when evaluating a company?
We're growth stage investors. So on average, the companies we invest in are growing over 30%, right? So these are high growth assets. That said, the building blocks of growth are where we spend a lot of time. So that will be understanding what's driving a company's growth around new customer bookings, back to, upsell bookings at a customer, price increase, right? And then we spend a lot of time, what is the retention rate? At what rate do companies hold on to their customers? And at what rate do they help their customers grow by selling them more software, right? And so that's kind of the top line fundamentals we look at. Gross profit, we spend a lot of time, because the beauty of software, one of the many beauties of the software business model is they are by definition high gross profit businesses. We don't have plants we have to fund. We don't have heavy costs of goods sold, right? It's hosting at AWS or Microsoft or Google, and a handful of people. So where we spend a lot of time is, does a company understand how their cost structure drives the fundamentals of their business? How does their cost structure drive their growth? And how does their cost structure drive their customer success? And how does their cost structure drive their product development and their innovation engine? And do those line up? So that's the level of detail we're going to spend with companies. So my advice is, as companies think about what are the building blocks to their continued growth and what is the near and medium term cost structure they're going to need to invest to support that growth, those are the details, those are the fundamentals that I urge management teams to be intimate with with regards to their own businesses.
And has any of that changed, Peter, from a few years ago, or would those be the same attributes you would have been looking at a couple years ago?
Melissa, we've always sort of thought about those as the key fundamentals. I think the market clearly was rewarding growth at an all-time record rate in 2021. Okay, so there's a relationship in the markets on multiple tied to growth, right? Folks have always paid a higher multiple for higher growth companies, and they're always weigh growth more than they'll weigh cash flow, right? Because the notion being, if you grow at a high rate now, you'll build scale faster, and over time you'll be able to drive profitability. That ratio got really, really high. The multiple paid to growth versus cash flow in 2021. It's come back down to more normal rates today. So that is a significant change, right, for many, many markets. That for a period of time coming out of the pandemic, growth was valued at a rate almost since, the internet bubble of 1999 and 2000. I'm going way back. I'm dating myself. But, this is at a rate growth was valued, and that's come back to a much more normal rate today. So growth will still be valued, but the trade-off between growth and profitability, or growth and loss, will be viewed in a different way than it was in 2021. And I think most companies have probably, come to grips with that, but that is clearly that relationship between growth rate and the investment a company must make to achieve that growth. That relationship is under a tighter microscope than it was coming out of the pandemic, where growth, there's a notion of people are willing to pay for growth at almost any cost.
Yeah, and I'd say it is interesting when I reflect on how things have changed in 3 years. I'd say some of that rebalancing is healthy. Obviously growth still, I always say you want to be the market leader in your space. You want to be growing and making sure that it's always growth first. But having that slightly better balance of the distribution of the weighting, I think, is going to generate healthy behaviors for businesses where you have to reflect inside and make some different decisions. So hopefully that sets them up well, I think, for what comes next. I think it has to. Next question that I've got, you talked about some of the attributes that you look for in companies. How long are you looking for demonstrated evidence of some of those results? When I think about a company trying to figure out their timelines for, okay, I think I might want to raise funding at a certain point, how many quarters, years should they be trying to get under their belts so that they've got those proof points at the time that they're raising?
It's a great question. So I think sometimes companies management teams get really focused on, I have to have demonstrated growth for a really long time. My advice is that the management teams that best understand and can clearly communicate why their business is growing at the rate it is, but more importantly, why they've built a predictable engine to drive that growth into the near and medium term, is the most valuable, right? So being able to say, hey, look at my 3 years of growth that's gotten me where I am. That's great. But growth investors are paying for the future. They're investing not into what you've done, but what you can and will do going forward. So, hey, check out my 3-year compounded annual growth rate. That's good. It's nice to have a higher number than a lower number for sure. But really being able to articulate why you have confidence you can continue to grow at attractive rates and the underlying reasons that will continue, that's the key, right? Being able to to defend and really articulate why the future will behave in the way you think it will is the most important attribute.
And I think that's great advice. And you're touching on an important part, which is, I think sometimes, you think it's about, okay, these numbers and this hockey stick curve and where's it going to go? But you're getting really into the fundamentals of how do I get comfortable to know that there's actually the engine that's in place that's going to yield these results. Because like you said, you're investing in the future. What do you think would be some of the most often overlooked areas that companies aren't minding as much as they should when preparing for fundraising?
When you're going out to raise money, we have learned as investors and as institutional, shareholders of our portfolio companies, we have learned that over preparing to talk to investors has always paid well. The flip side of that is even more stark. Under preparing and being a little bit loose, to use the vernacular, is really risky. So taking that extra time, and that is making sure your data, your information is organized well and clearly thought out. Working on the presentation, both written and oral or verbal, that you're going to give to an investor, over prepare around that. So this notion of being good at telling your story and having the data well organized that supports the story you're wanting to tell is incredibly valuable. Doing that well is really important because that allows the management team to control, in my opinion, the narrative. That allows you to really talk about your business at the level and around the areas you want to talk about. And so to answer your question more specifically, let's talk about an example, right? Growth in my world is really important. Companies that, achieve growth by selling large deals, as an example, need to demonstrate that in the future there are significantly more large deals to go get. And then companies that, sell at a lower price point need to demonstrate that there's high velocity in their business, that they have figured out how to drive high velocity. So in other words, does your go-to-market organization match your market opportunity? And have you demonstrated that you understand that and that you've got enough results? And so I talked about showing some results, but do you have a predictable model that you can back up with data and that is backed up with how you articulate your opportunity? So in other words, you can't just go into a meeting and say, hey, look, we've closed a couple of huge deals that have gotten to us where we've gotten, so just trust us, we're going to keep getting those. Versus, hey, we've done these big deals and here are the 10 companies in our pipeline that look just like those, and here's why the value we've provided and we've demonstrated will be available to those customers. You just have to really be able to articulate why you're winning and that you're well set up to continue to win at a similar rate.
Yeah, I love how you highlight really the importance of that operational rigor, even when a company's smaller and just starting to think about fundraising. You can't underestimate the importance of putting in place the right plumbing so that you're really ready to show that this, whatever you think you're going to be able to do is going to be achievable because you've built the right infrastructure to prove it, and also I think to be able to capitalize on those opportunities as they come because you show you have the muscle to do that.
And Melissa, the only thing I would add, you bring up a really good point, is there is not one size fits all for companies, right? You'll get a lot of advice. Okay, companies that look like you have this exact cost structure, or this exact model. You know, folks should listen to that. But more importantly, and most importantly, they got to understand why their business is working, why their business is set up the way they've set it up. And every company is a bit unique. So lean in to what's unique about how you've built your business and why that uniqueness will be part of what drives success going forward.
We're hitting on this a little bit already. Are there other attributes, Peter, outside of pure financials that you look at? Is it disruptive products and industries? Is it tenure and experience of leadership? You alluded a little bit already to management's ability to be able to articulate the story. Are there other components or elements that people should be thinking about when ultimately looking to work with investors?
Where we spend a lot of time when we're making a new investment is, has a company achieved what we call product market fit? In other words, is there demonstrable evidence that customers are using the product that they've bought in a way that is similar to how other customers are using it and are deriving similar value from that relationship? So is there clear product market fit? We at JMI don't like to take a lot of product market fit risk. We are more than willing and lean into taking execution risk. And we are willing to take market adoption risk. So I think for companies, really understanding why their customers are using their products and how they're going to take advantage of that product market fit and drive continued success going forward is where we spend a lot of time, right? Those are some of the attributes. Is there consistent value being derived by customers across the customer base? And we'll do firsthand, due diligence, and talk to the customers and hear firsthand from customers. Are they getting the value that we think they're getting after we've talked to a company?
That intimate understanding of your customer base and why they're using your product, so easy to miss. People get excited about high growth rates. I think everything you've talked to alludes to a really high say-do ratio. Say you're going to go do something and then ultimately turn and do it, and not doing it due to coincidence or just happenstance, but doing it because you had a hypothesis, you understand your customer, you understand your markets and your business, and then you go out and execute on it.
Peter, JMI has had a really successful track record of building some of the best companies around, or being involved with some of the best companies. You've also sat at the table as companies were looking to raise, where you were bringing maybe other investors into the table. What advice would you have for companies in terms of what they should be looking for in investors when they're thinking of raising capital?
My advice I'll just talk about the advice I've given my own CEOs, who I sit on a board and I'm already partnered with, is, make sure you've got a good and feel good rapport with a new investor, right? Do you have confidence and comfort that the new investor understands the business you're running and understands the market opportunity ahead, and finally understands your strategy for executing against the opportunity? They're not marriages, but in business, they're as close as you're going to get, right? New investors sitting on your board, you want what we call, really tight alignment. And when you don't have alignment, it's just not as much fun. And if it's not as much fun, it's just harder. And so build the alignment on a personal level and on a professional level with new investors, right? Valuation is important. Deal terms are important. But alignment around what it is you're trying to achieve, how you're going to achieve it, and over what time frame you want to achieve it, build alignment on those key issues, and good things will happen.
Yeah, I love how you liken that to a marriage because the last thing you want to do is agree to this and then find out 3 months, 6 months later that you're really not on the same page about where you're going, right? You're absolutely no fun at all.
Peter, if you were to distill down our conversation into 2 pieces of advice that you'd provide to somebody looking to find an investor, what would it be?
Really understand what is driving value in your business today and what will drive value creation in your business going forward. So get intimate with your business. And second, and related, is be prepared to communicate that value creation opportunity and have the data and the information well organized to back up your hypothesis, right? So be crisp on your business and be prepared for someone to evaluate your business.
Excellent. Understanding your value drivers and being prepared. Very sound advice. Peter, thank you so much for sharing so many great insights and suggestions with us. Now, whenever we have a guest on the show, we do have 2 rapid fire questions that we like to ask them. So are you ready?
I am. I love it.
All right. First one, what is the best piece of business or leadership advice that you've ever received?
This is a short anecdote. So when I was early in my career, maybe 24 years old, I was working decently late at night, and I was with some other very young folks on our team, and we were sitting around spitballing about what stocks we should buy to help drive our personal wealth. Now at this time, we're talking hundreds of dollars probably, right? So we're sitting around trying to sound as smart as we can, and our boss walked by, and our boss says, "Okay, hey team, that all sounds really interesting, but here's my advice. The best investment you can make is do great at your job and invest in yourself professionally." So I've always tried to give that advice as well, which is this is a long race. Success comes over time, and invest in yourself and do great at what you're doing. Love what you're doing, but do great at it. So that's one. And then the second, around leadership, I just wanted to add is I think this quote's attributable to Colin Powell, which is, don't let your ego get in the way of your decisions. In other words, allow your decisions to change over time. Allow your opinions to change over time.
Love it. 2 great pieces of advice, Peter. Second rapid fire question is, what is a book that you've read that you would recommend, the most impactful book that you've read?
I'm going to try to keep this in the realm of business, which is one of my passions, and then in the realm of another one of my passions, which is sports. So there's a great book that was written 15 years ago, made into a movie called Moneyball. And I highly recommend Moneyball. One, it's an incredible read. It's really fast. It's really, really interesting. But at its core, it's about baseball, and it's about the success of an underdog. But what it's really about is changing how folks or teams or organizations address problems and opportunities in a way that, tweaks the model, allows them to look at an opportunity differently than has been looked at for many, many years. Force yourself to look at things in a different way. So that's one of my real takeaways from the book. The other takeaway is, in the book, there's an aging star, and he's at the end of his career, and he learns how to realize what his value is at this stage of his career is different than what it was perhaps 10 years prior. And by him changing how he added value to the team was better. And the takeaway is teams can achieve a lot if folks really are willing to check their ego at the door, to understand where their value is on their team at that time. And when teams do that, great things can happen. Underdogs can become the big winners. And that was my takeaway from Moneyball.
Valuable advice there. Thank you so much for sharing. And thank you, Tom, for joining me on today's episode. And if you like what you heard today, please leave a review on any of the streaming platforms. We love to hear from you, and it helps other listeners to find the show. For the CFO Show, I'm your host, Melissa Howatson. Until next time.